Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have back the CEO, Andrew White from Char Technologies. Char trades on the TSX Venture Exchange under the symbol YES and on the OTC under the symbol CTRNF. The company is currently trading at 47.5 cents with roughly 71 million shares outstanding, or about a $34 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks so much, Trevor. Always great to have Andrew with us. I think you've been with us at least 2 other times in the past. So welcome back.
Yeah, it's always a pleasure to be here, Paul, as well. So thanks for having me.
Fantastic. So Char Technologies in the environmental space, we can call it that. There's a whole bunch of things that you guys do. You've given us a pretty in-depth presentation in the past. So we're happy to have you here for updates, but before we jump onto any updates, why don't you remind everybody listening exactly what Char Technologies does?
For sure, and I was going to share one slide, but it's disabled, and that's okay. I can talk through it. It's no big deal. So Char, we're an environmental technology and services company, but the core of the business is what's called high temperature pyrolysis. So it sounds scientific, but it's heating stuff up to about 850 Celsius without any oxygen present. So this is kind of what it looks like on the right. That's our high temperature pyrolysis unit. And we have 3 distinct market verticals. Each of these plants will operate in one of these 3 market verticals, but at a high level, we're taking in low value to negative value materials, biosolids being sewage sludge, digestate compost, wood residuals, so like bark and sawmill residuals, heat it up in our plant here and make clean energy in the form of a gas, which we can take to renewable natural gas, syngas, or green hydrogen, and biocarbon, so biochar. So, we have a biocarbon we make for the steel industry to offset coal in their blast furnaces that we call clean fire as one example. So as sort of the 30 seconds or less, that's the core of our growth. That's where we're seeing, tremendous opportunity, and that's, what we're really excited for in 2022 is the continued development of this market space.
Fantastic. Great job. You've done a much better job describing it than I could. So good.
Thanks.
No, since we spoke last, you've actually made some significant announcements. Why don't you update us a little bit on some of the things that have happened in the last little while? You've got a recent facility announcement out of Quebec, but there's some a facility out of California as well that maybe you can update us on that and anything you want to around those things.
For sure. So we'll start chronologically, like newest, and then work our way back. So the Quebec Project is in a town called Saint Félicien. So it's Saguenay-Lac-Saint-Jean. So about 3 hours north of Quebec City. And I think, one of the key highlights of this project is that it is co-located with an existing biomass cogeneration plant. So this plant is taking in wood and primarily wood waste, low value residuals from the sawmills up there, burning it to create electricity through their boilers. Mm-hmm. And so what that means is the plant has a need for thermal energy. It has, biomass handling, truck scales, dumpers, grinders, the like. So, a lot of that infrastructure that's needed to handle biomass. And so the project is a multi-phase project where first we build one of our high temperature pyrolysis kilns. The plant can handle all the biomass handling, so don't need to invest in any of that CapEx. And we process the biomass, we make a syngas, sell it back to the power plant. They've got a purchase agreement, so it's very, very simple to just run the gas pipe to them. And we make our biochar, our biocarbons, and we sell that. And that's phase 1. So we can get phase 1 deployed for relatively low capital. There's not a lot of balance of plant design work that needs to happen. The site's there, the people are there, the municipality The MRC up there is very, very receptive. They've kind of funded a biochar demonstration and research facility up there. So there's a ton of community support. So we're really excited because of the opportunity in terms of, biomass availability, biomass handling, sort of the super CapEx light ability to really just put the kiln in place and get it running. And then of course, phase 2 would be getting into that renewable natural gas, but there's contracting and permitting that just takes time. And so we can get this thing built and cash flowing really, really quickly. So that's obviously very exciting. The quicker to cash, the better. So that's the one we announced not too long ago. The one we've talked about previously is in California with Hitachi. So Zenonova, they've got what's called an anaerobic digester. So they take in food waste and they make biogas. And then we take their compost and process it through our plant. And so that's progressing quite well. We're, deep into the permitting process with, land use and building permits and, air permits and all those good things. We're fabricating the equipment, so it's into procurement now. Our target delivery date is still late spring, early summer. As long as everything goes smoothly with the permitting, we should be able to turn it on and do some initial running in that time frame. And we've got some guests from Hitachi at our facility in London this week, sort of both from their US base, their base in Switzerland, and their Japanese base, sort of one representative from each. And we're doing some additional trials and, kind of tweaking the operation. So once it's built, we're up and running quickly down there as well. The other one we've talked about previously is Kirkland Lake, and that's a greenfield site doing biomass. We're still progressing nicely with the preliminary design work. Before the winter set in, we did the surveying, so we're able to do some of the initial plant work. And we're fairly deep in the negotiations as well with the renewable natural gas off-taker for that site. So, things on those 3 projects are going really well, and kind of the influx of opportunity in clean tech, be it in the biochar and the carbon credit markets, in the renewable natural gas and green hydrogen, all of those spaces are still accelerating, and the markets are just growing and growing and growing. And we're definitely pursuing it rather aggressively to keep that going.
I wanted to talk to you about that because before we got on air, we sort of jokingly laughed about the the stock market hasn't really kept up with sort of in parallel with the actual opportunities and the excitement around a lot of these opportunities you guys are seeing. Albeit, I mean, there's all sorts of ESG stocks have been hit the same way, but you guys are really active right now. There's a lot of opportunities that are coming your way. Clearly, you've got a number of facilities up and running now that you didn't have before. Talk a little bit more about kind of the general sort of environment out there for these opportunities. What can you tell us more about sort of the lay of the land?
Yeah, so it's a good point. I mean, I think every tech stock across the board, be it clean tech, ESG, or otherwise, has seen a bit of a decline. I mean, we're still trading above our 52-week low. So I think our shareholders, I think, understand what's going on and what we're pursuing, because that market space hasn't changed negatively to kind of reflect that slight pullback. And what I mean by that is you still have British Columbia and Quebec that are pushing hard to increase the amount of renewable natural gas. You see more procurement coming out. Another RFQ came out a couple weeks ago, or sorry, not a couple weeks ago, I guess this was just before December, but for more gas in the Quebec pipeline, more renewable gas, because they need it. We've got now more traction with additional metallurgical and steel companies in the US, where they're seeing the need to get into reduced carbon because of their global footprints and their global ESG requirements. So none of that has gone away. It's kind of done the opposite. It has grown and continues to grow. And so over the past year, we've been pushing project development, getting some of these project partners in line, like with St. Felicians, there's a couple of partners there. And so in the next kind of 3 to 6 months, we expect to continue to execute as we have been on getting these projects from kind of the drawing board into a place where we have agreements in place and we can move them forward. And, in alignment with that, there's, still a fair bit of government support. Obviously the economics of these plants speak for themselves without government support, but certainly helping with plant CapEx through various opportunities. Those are still real. They're still there because it's still, important for society across the board to decarbonize and to follow these ESG metrics. And, I think politically it makes sense. And so we are seeing still a lot of really good opportunities that, we can leverage off of to finance and build these projects.
I want to remind everybody that's listening, if you've got any questions you want me to ask Andrew, feel free to use the chat function and I'll do my best to ask a question. The timing, you mentioned a little bit about some of the facilities that are up and running, that will be up and running in the next little while, but give us a better sense of timing in terms of when does it start to have a meaningful impact revenue-wise to your business? What sort of still has to happen before you get there to see what the economics around these things really look like?
Yeah, it's an important question for sure. And the California project, as I said, we expect that to be turned on late spring, early summer. So our fiscal is September. So within this fiscal, we see that project operational. There's a couple of other, project opportunities where we are selling equipment versus doing the build, own, operate. We see the real future for Char and long-term growth in build, own, operate. But a couple, CapEx sales help with the cash flow infusion, and those are a couple of well-developed ones that we can also see coming in sort of late this fiscal as well. But really, when the other BOOs start to come online is in the next fiscal year. I mean, there's just the realities of doing permitting and site construction and development, but we do have a relatively short time frame when you look at other types of projects, because to remind people on the call who have been on other ones, our deployment strategy is still modular. So we build the entirety of the plant in a factory. It's fabricated, it's on a skid. It gets shipped and assembled on site, but the equipment doesn't need on-site construction. We need, a pad, a pre-engineered building that, is fairly cost effective and doesn't take a lot of time to build, and, some electricity run to that site. So we see this, some of these projects, these build, own, operate projects coming online in our next fiscal. And that's where the growth really starts to hit.
Yeah. Now, whenever we hear somebody say build, we keep hearing about supply issues, shortages, logistics, all that sort of stuff. Are you guys facing any issues around material or product supplies right now?
We haven't so far. We're certainly looking around at what our alternatives are if that does become a reality for us. But I guess the nature of our supply chain, it hasn't been disrupted, like others. The metals that we use are pretty standard. Burner packages haven't really been hit, and the electronics that we use are from either Allen Bradley or Schneider. Both are well-established global companies, and we don't have the same types of electronics that cars that need these chips do. I mean, they're kind of these controllers that go on a big panel, and so far it hasn't been an issue. And I would say over the last 12 months and maybe even more is when sort of everyone was concerned about logistics. I'm sort of seeing a light at the end of that tunnel, that things are settling down. But so far so good, but we are identifying where we could potentially source specific componentry that's, you know, either longer lead or critical, just in case.
Andrew, we've seen the price of oil, we've seen the price of natural gas, you know, hit some, you know, significant recent highs. What kind of impact is that having in your business? I got to imagine that, I mean, it's high energy prices is good for ESG, it's good for the kind of products you sell, but maybe there's more detail you can give us.
Yeah, I mean, it certainly is, because it closes the gap a little bit in what the market price for renewable natural gas is, for example, and what fossil natural gas is. So, you know, in the Canadian context, it hasn't yet had much of an effect, because it's a little bit longer term focus in Canadian renewable natural gas. We've got these mandates to fill a certain, you know, amount of our grid with RNG, and it's a little bit less market economic and a little bit more policy driven, and the gap is huge. I mean, you know, BC needs something like 40 pentajoules of energy, which is, you know, a pentajoule is 1,000,000 gigajoules, and a gigajoule is 1,000,000 megajoules. So if any of those units make any sense, it's a lot of energy.
Yeah.
But to put it in a different way, you know, BC needs about 40 pentajoules, and Canada produced 6 pentajoules. This is all renewable natural gas numbers. So there's such a huge, you know, supply gap that, you know, whatever the oil price and the natural gas price are,
relevant.
It yet hasn't affected, but you know, I think we will see the effect a lot faster in US market opportunities, where, you know, you've got these much more market approach to renewable energy, either through the LCFS, low carbon fuel standard market, or the RIN markets that are much more variable, because they're priced on, you know, kind of a carbon credit type of concept. So those ones could move faster, but for us right now, it's, you know, really focused on the Canadian utilities and the kind of long-term offtakes, because that's what's really exciting from a return perspective. I mean, the pricing is excellent, and, you know, who better to have a long-term offtake agreement with than, you know, a Canadian gas utility? They're going to stick around. So that's kind of the focus right now, for sure.
Yeah, that makes sense. That makes sense. I mean, so technically, I guess you got 3 facilities that are either in construction or, you know, soon to be completed, I guess. Give us a sense of the economics around one of these facilities. Maybe, I mean, they're all going to be slightly different. I'm sure they're going to have different input costs and whatnot, but give us a ballpark idea of what a facility does for you economically.
Yeah, so, you know, we can look at, and again, we'll kind of focus on the idea of a module, because of our modularity approach. So our largest module processes 3.5 tons per hour of biomass. That largest module would produce on the order of 200 to 250 200 to 250,000 gigajoules per year of renewable natural gas. Once it's fully deployed, and that depends a little on the feedstock. And that facility would produce on the order of 5,000 tons of biocarbon. So when you do kind of the quick math, you know, the RNG pricing is, you know, for modeling purposes, you can use $25 a gigajoule. So that's the gas side. On the carbon side, you know, it's $500 or $600 a ton. So you can kind of quickly see it's additive, but the real economics still are driven by that gas piece, which is good if that's what, you know, we're getting the long-term offtake for as well. And then your feedstock cost, depending on the site, it's either, you know, $10 a ton all the way up to about $30 to $40 a ton, depending on your location, how far away you have to pull it in, and how much pre-processing you have to do. So hopefully that gives kind of the operating perspective of kind of the overall ins and outs. And then the plant itself, because it's generating the syngas, we need thermal energy, we need heat. But once we're running, we take a slipstream of that gas to run the plant. So we actually don't have big utility costs from the heat side because we're self-generating. Our largest plant uses, 400 kilowatt is kind of the electrical load. So we do electrical plus, regular maintenance, amortized, and, kind of all those other OPEX costs. And general OPEX, including all of those, is on the order of 300,000 a year. That's non-labor OPEX because, with the modular approach, we're co-locating often. So we have the opportunity to leverage existing personnel. So whether a greenfield, we obviously have to hire more people. Plant like, in California where we're building it on the back end, we don't really have to hire anyone because there's already some operational capacity to run that plant. So that's why we usually leave that piece out because it is site specific. And then our kind of investment cost on the equipment side, plus some allowance for site work, it's on the order of 12 million for that module. So, when you kind of run all the numbers, the kind of basic payback is in the 2.5 to 3 year mark on that module.
Perfect. I like it when you simplify it in terms of how many year payback. That makes it. It's the crayon approach that I talked about for investors like us.
Absolutely.
Okay, so you're still more or less in build out mode. Expenses are high. One of the questions you just had coming in here: do you foresee yourself having to raise money?
Yeah, short answer is yeah. Yes, we're doing a financing now. It's kind of a, as you kind of asked, markets are a little bit softer right now, so we're not necessarily going for the huge dollars, but we want to have enough to give us decent runway that we don't have to take the foot off the gas on any of these projects. That's kind of where we're sitting right now. We want to be able to keep progressing quickly on the projects, and so it's a little bit of funding to keep that process going. When we look at the bigger capital requirements, once we're deploying this equipment on the sites, which is coming up, it's a balance of what's our investment piece, partners that are at the table for some of these projects, and then the government funding that I mentioned. There's a couple of really good opportunities for us that we kind of see coming down the line in the next 3 months that we can hopefully close on and put towards a couple of these projects. And there's some really interesting government supported but still more traditional project finance like debt instruments that are also available to help support these projects. So in the immediacy, it's how do we keep the foot on the gas on development and keeping initial pieces through procurement so we can get it going. But on a project by project basis, we don't expect each of those modules, that 12 million that I mentioned, we don't expect to have all raised equity to pay for that piece of equipment. There's a lot of project finance, grant funding under various repayable and non-repayable options, project partners. So there's lots of good ways to get that financed. And on the back of a lucrative, RNG contract with a gas utility, the door really does open for traditional project finance.
Yeah, I could see that. Why don't we talk about the financing then? How much you're looking to raise and what kind of terms on the financing?
Yeah, so we're doing up to 3 million, so it's relatively light. Like I said, it's enough to keep the foot on the gas for some of the projects. James is on the call. I might have to lean on him because I've been on calls all day, and there was a little bit of back and forth with the board. So if you remind us, James, what the final numbers were on the deal term?
Yeah, so it's a 45-cent share in a half warrant at 60 cents. Good for 18 months.
Perfect. Thanks.
Okay.
And it's worth mentioning. I'm the second largest shareholder, and Andrew and I are the two largest shareholders. I'm committed for a minimum of 50K. I may do more actually, because we'd originally hoped to do this financing at a higher price. And most of the board all the board are participating. How big the quantum? Most of them are about the same as me. Eric Butel's in for 50. Hugh Cleland is in for 50. Paul Pellegrini's in for 50. Anyway, I could go on, but I'd say the immediate insiders are $500,000 for sure. My friends and family are another $500,000 for sure. So we're well over $1 million, but we see the Small Cap Discoveries Group as a key group, and we want your participation for sure. You've been supporters since our last financing, and that's why we wanted to do this update call the minute that we announced. So.
Yeah, and that's much appreciated. So it's sort of it's almost like we've broken the story here. So that's fantastic.
That's right.
So yeah, I mean, we can get into that later as far as the listeners. If you're interested in participating, you know, we'll have the opportunity to chat and get you all the documents and contact people that are necessary. So fantastic for that. Okay, well, good. Well, we sort of answered the question in terms of funding. You know, raising a bit of money now to keep moving as fast as you guys are moving makes a lot of sense. What you know, sort of deviating a little bit, what other challenges do you see ahead? You know, now that you supposedly have some money coming in, what else do you still face? What kind of hurdles?
I mean, it's interesting because it's all capacity based. It's you know, it's that kind of growth story of, you know, how do we keep up with the opportunities, you know, have the right people behind us, keep building our capacity, but, you know, do it in such a way that we're not getting so far ahead of revenue that our burn rate gets too high. So, you know, that's accomplished by, you know, hiring some of the right people and then looking at how do we use or leverage the projects to bring on, you know, the individual, you know, engineering design requirements for those projects in a way that we don't necessarily have to deploy, you know, the rack rate cash to get those resources to do the design and the construction of the plant. So, you know, whether it's, you know, a small position in that project or, you know, some other ways to leverage, you know, these great projects to pay for their, you know, the labor required both on an engineering side and on a deployment side is really where the balance is. You know, it's an interesting place to be in where, you know, we've got the focus. We're not kind of looking at all sorts of different projects with all sorts of different inputs and outputs. We're looking at a very specific type of project, but it's still, you know, refining which ones are the focus because there's so many good opportunities, and, you know, making sure we're balancing our internal resources, both human capital and financial capital, and growing our team in a sustainable way to support the growth of those projects. So, you know, it's kind of it's a good problem to have, but that's sort of where the challenge is right now, if I can put it that way, is just making sure that's all balanced appropriately.
I mean, I you know, the technology has proven itself. You're now starting to really scale in bigger opportunities to sort of prove out the capability here. I'm really trying to understand, how big could this be? Like, if everything kind of plays out like you hope it will here with these 3 projects, how big could the addressable market be for your specific technology?
Yeah, I mean, it's as James will know, because we talk all the time, you know, I often fall back on the engineering side of things where we tend to downplay things a little bit. But so when I say massive, like it's hard to really explain just how massive it is. And when we look at those numbers, you know, remember the British Columbia requiring 45 pentajoules, that's 45 million gigajoules at $25 a gigajoule. That's the market opportunity in one Canadian province per year for this. And where we're positioned really well is there's 2 types of technology that can get us there. One is anaerobic digestion, runoff of organic waste. The second is high temperature pyrolysis, runoff of woody biomass. And on the organic waste side, back to the Quebec market, you know, I think I probably mentioned this on a previous call, but for that all of that gas that Quebec needs to be made domestically in the province of Quebec, over 80% has to come from pyrolysis, because there's only so much food waste and grocery store waste. And I'm not being negative on anaerobic digestion. I think it's a fantastic way to take food waste and organic waste and turn it into a higher value resource. But the market demand is so high, and there's, we're kind of blessed with so much forestry, be it the residuals from the sawmills, or be it still in the forest that's sustainably harvestable, but is kind of staying there. And the natural resources ministries are looking for market opportunities to harvest a little bit more, create jobs, but still within kind of a sustainable harvest quota. Maybe another numerical example. In our Kirkland Lake project, we're going to consume 75,000 tons per year of woody biomass to make 500,000 gigajoules per year of RNG. The biomass-fired power plant that recently shut down in the town was consuming 350,000 tons. So we're consuming 75,000. There's 350,000 that's available just from that other asset not consuming it. And that's a story that is playing out across Ontario and Quebec primarily. And so it's huge. It's kind of huge. And that's where we go back to your previous question is, we are keeping the discipline on making sure we are getting the right number of projects in queue that we're able to execute on, get operational and get running in the short term. But in the medium term, it's really this blue ocean of opportunity. I love the blue ocean, red ocean strategy, and this is definitely in the blue ocean side of things.
Yeah, I think it really helps how you describe what the sort of the almost legislative demand is just in BC, and realize how little there is really today to supply that legislated demand in just one province. I think that makes it real obvious what the opportunity looks like here. Andrew, I've got another question that came in from one of the listeners. It says, in January newsletter, Char mentioned they are working with a major automotive company. How's that project going? What type of work is being done?
Yeah, it's going very well, as hopefully listeners can appreciate. Often the big sort of automotive companies don't necessarily like their name being sort of used in promotional stuff, but they've got multiple sites. We're working at multiple sites, and that's actually in our carbon finance unit. So we're working with them on helping them understand carbon markets, how they should opt into some of the carbon markets, how they can generate credits and actually see some better returns for the facilities. And the reason we've got this carbon markets consulting group within the overall organization is, of course, the outputs of a Char HTP facility also rely on that expertise. So it's keeping that expertise in-house, but also looking at how we can grow that expertise and bring on more of these types of clients that have multiple sites that all require carbon emission accounting, and help deciding how do they participate in emerging carbon markets depending on what jurisdiction they're in.
Fantastic, thanks for that. We've got a few minutes left here. We always like to ask a question, just looking forward as investors, what sort of catalyst should we be paying attention to, or what milestones do you think we should be watching out for in 2022 here?
Yeah, now that we're in 2022, yeah.
Exactly.
I mean, from Char's perspective, I think it's primarily two. It's there's more projects in the hopper, so it's new projects that have good partners associated with them, so there's support there that we're not kind of going all of them alone. We have tied up feedstock supplies and the like, and operational support and financial support. So it's a couple new projects. It's really making good progress on the existing projects we've announced. And the third one is really around project finance. So where of the government funding opportunities, both repayable and non-repayable. In any case, they're all non-dilutive. As those come in to support projects, as we bring on opportunities with more traditional debt style of project finance that, to be frank, no debt supplier for project finance wants to supply one project like a Kirkland Lake, which is, total CapEx equipment all in is about $30 million. Like that's a, they cover half of that's $15 million. Like that's not the check size they want to write, but they're happy to write a big check to give us a facility to cover multiple projects. So, we're really pushing on making sure that's lined up such that as we really start to have to deploy the capital, we've got that project finance piece. So, I think from a key sort of milestone through 2022, those would be kind of generally the three that are going to keep us on this growth trajectory and deploying these projects.
Andrew, is there anything we haven't covered? And is there any sort of, if we've covered everything, what's the key message or key, sort of takeaway you want everybody to walk away with today?
Yeah, I mean, I think fundamentally the key message is, ESG is still around and still growing. Renewable natural gas and carbon economics are still growing. And so as we look at what our opportunity is in the future and how we're going to continue to grow and continue to see opportunity, it's, deploying assets with long-term offtake agreements to keep that sustainable revenue growing in a marketplace that is in no way slowing down, like the growth in carbon finance and in carbon credits and renewable natural gas and our biocarbons, all this thing, like it's still exploding, kind of regardless of what the kind of short-term public markets are doing. So we're still very enthusiastic about 2022 and kind of where the opportunities are going to continue to be for the company.
Fantastic.
Can I give one, Paul, as well? Just one.
Please, yeah. Yep.
I've been an investor in Andrew. We met originally because I was a mentor and coach to him at an innovation center. And I originally, for a couple of years, was a coach and mentor to him. And then I initially wrote a $100,000 check and then more and more. And now I'm heavily invested and been a partner of his now for 5 or 6 years. Quick refresher, February of 2021, February the 5th, so just more than a year ago, we raised $6 million at 32.5 cents with a 40-cent warrant. We had a terrific run with the market, and let's face it, a lot of boats got raised. And I believe the market's been lousy for everybody in our space for the last 3 or 4 months. I'm still a big believer in the business, and I think the business is better than it's ever been. Where we are at this very moment is we need some cash to continue doing what we're doing, and we're putting our money where our mouth is at 45 cents and a half warrant at 60. And I think it's a fantastic opportunity. We will need to raise more money down the road, but at the juncture we're at on the beginning of February 2022, I think it's a really good opportunity to participate in this financing for those that want to be with us.
That's fantastic. It's a perfect place to end this. There is a financing opportunity. I want everybody that's listening today, if you've got any questions around that, feel free to reach out to Trevor and I, and we'll put you in contact directly with the company. Gentlemen, I want to thank you guys for joining us today. It's always great to catch up. We will be in touch very soon here, and good luck with everything. I mean, one last thing, if anybody really wants more information, a website or contact point, who should they be contacting?
Yeah, I guess since this is being recorded, you can replay it, so I can lay the all out. chartechnologies.com. Andrew.white@chartechnologies.com is my email address, and it's within this group, so 647-968-5347. That's my cell number, so try not to call me at 2 a.m., but otherwise I'm always happy to answer questions.
Paul, I just put my phone number and my email in the chat, and I'm happy to take calls as well.
Okay, fantastic. We'll make sure that gets out to everybody. Gentlemen, thanks for joining us today. We'll catch up with you guys real soon.
Thanks again.
Thanks, Paul.
Thanks,
Trevor.
You got it. Bye.
Thanks, Trevor.